centre of food and drink business. Welcome to Play, our weekly news roundup brought to you by GS1 Australia, the only authorised source for your barcodes. For 50 years, GS1 standards have powered business to trade seamlessly, efficiently and safely. Learn more about the next generation of barcodes at gs1au.org. In the news this week, it was the New South Wales Labor government's first budget, its first since 2010, with Treasurer Daniel Mookie taking a tip from federal Labor stalwart Bill Shorten and delivering the best zinger of the day. After 13 years in the wilderness, Mookie said that the government would treat schools, hospitals, railways and roads as assets to revitalise, not liabilities to neglect. Someone hand the opposition the solo site. But more seriously, the government's plans for schools and hospitals and roads and energy and cost of living have been well received, but there seems to be a void when it comes to budget expenditure on business. For example, I'm yet to find mention of Investment New South Wales or any grant or funding programs for business beyond the $480 million allocated to manufacturers that are building components or products in the renewable energy sector. The New South Wales head of AI Group, Helen Waldron, said that the Employer Association was keen for more details, particularly on the halving of the budget expenditure on the Department of Enterprise, Investment and Trade. I suspect so are many others. Paine Schwartz revived its offer for Costa Group from $3.50 to a share to $3.20, shaving more than $100 million off its offer. What I think is interesting here is that when Paine Schwartz gave its first indicative proposal in July, Costa Group said that the two had started discussions about a takeover back in October 2022, when the private equity firm bought almost 14% of the fresh produce powerhouse. Now, in those discussions, the share price was in the range of $3.20 to $3.30, so why the bump to $3.50 only to then drop it back? Like, Costa's half-year results were mixed, but I'm unsure how that warranted Paine Schwartz deciding the company was worth $1.49 billion rather than its initial $1.6 in just 3 months. I'm guessing that's why they pay them the big bucks and me not so much. Now, in what the Fin Review has called a feud, the A2 Milk Company cancelled its exclusivity contract with Synlait this week. For context, you might remember earlier in the year, Synlait updated its financial year 23 guidance range to -$5 to +$5 million because of a drop in demand for its advanced nutrition products, i.e. infant formula. It wasn't a particularly subtle shot across the bow, as it exclusively manufactures infant formula for A2 Milk. And A2 Milk also owns a 20% stake in the business. So fast forward to after the markets closed on Friday, because that's when A2 Milk sent Synlait a letter saying that it was cancelling its exclusivity arrangement on platinum and China label infant formulas, because Synlait had failed to meet the required delivery in full and on-time levels. But, it said, Synlait was still a very important supplier. Of course, the elephant in this equation is A2's Matura Valley Milk, a purpose-built dairy for nutritionals that is currently running at a loss. A2 Milk has said previously that it is expecting MVM to become profitable in 2026. Synlait is disputing the cancellation. Before we move on completely, Synlait also updated the market this week saying it had completed its bank refinancing. With $470 million in working capital and revolving capital facilities, it will have to make a repayment of at least $130 million by the 31st of March next year. That just adds a little bit of spice, doesn't it? Now, that's all for this week. Stay tuned, though, for next week's Play, as I will be coming in hot from somewhere that isn't here. I know, I can already sense your anticipation. In the meantime, please subscribe, tell your friends and colleagues, and head to the website for all these stories and more. Thanks to GS1, and with that, I'm Kim Berry, over and out.